go. So here we have the topics for tonight. Who is OJM Group? Why investors make poor investment decisions, common investor mistakes, how to avoid these mistakes, and then we'll discuss a few year-end investment strategies that you might be able to make over the course of the next couple weeks that may help out, a tax situation or another situation in some of your investment accounts. Okay, so let's, I always like to say that an investment presentation would not be complete without at least 2 pages of disclaimers. I'm not going to read all of the bullet points here or on the next page, but we definitely need to make sure that we show them to the group here for our compliance purposes. Okay, fantastic. So who is OJM Group? Well, we are a multidisciplinary firm. We're based out of Cincinnati, Ohio. We have offices in Florida, Texas, New York, and Arizona. And we really are here to serve our clients in many facets of their financial lives. We help them with asset protection, insurance, cash flow planning, budgeting, taxes, and then specifically investments. Terry and I are responsible for running the Registered Investment Advisory division of our firm. And you can see here in this bubble, we're on the top left-hand side. We're a fee-based registered investment advisor, and we are currently managing almost $200 million for clients in all of the United States. We are responsible for a lot of things. We watch the markets on a daily basis. We talk to clients. We build portfolios. We trade those portfolios. We rebalance those portfolios. And, it's obviously been a very volatile time. So we've been talking to a lot of, of our clients here recently. And, we do over the course of the year because we know that communication is extremely important. And that's, one of the main reasons we think that you really have an investment advisor. We also do a lot of planning on the tax side, the budgeting side for clients, cash flow, retirement, funding, etc. So this slide here, you can see at the end of the webinar, you'll have an opportunity to sign up to receive a free book or one of our other brochures. All attendees are going to have the opportunity to do this as just a thank you for joining us today. Okay, well, with that being said, Terry, I'm going to turn the presentation over to you, and we'll discuss firstly common investor mistakes.
Great, thank you very much. Today, the first thing we're going to talk about is some common investor mistakes and why individual investors lag the overall market many times, and what can be done to solve that. And we're going to start off here with just a view of annualized returns, and this is a study that's done by the Dalbar Group out of Boston, and they update their study every year. This shows through December 31, 2009. Year to year, these numbers don't change that much, but if you see the average stock fund investor over the 20-year period prior to 2009 earned 3.2% annualized returns in the equity markets. The S&P 500 over that time was up 8.2%. Clearly, individual investors have been lagging the market, and the average bond fund investor hasn't even outpaced inflation. So, why is that? We're going to, next up is a poll. We'd like you to chime in and let us know your thoughts. I'm not seeing the poll questions. There we go. Yeah, is it the issue having too much money in one investment, trying to time the market, or not paying enough attention to asset allocation? Well, the overwhelming response was asset allocation. 100% of the folks chiming in selected that, and that is correct. If we take a look here, the most detrimental mistake investors make is not paying enough attention to asset allocation. Trying to time the market is a close second. We'll talk in more detail about asset allocation, but you know, all evidence that has done in studies has shown that virtually no one has been able to show that they're able to time the market with regularity. In a lot of cases, that makes a lot of sense. The market in short term fluctuates randomly. Over the long term, though, certain patterns do emerge, and you know, those can be taken advantage of. There's other issues that come into play, having too much money in one investment or holding on to investments too long, and as you can see there at 8%, buying overvalued investments. So there's a number of mistakes. We're going to focus on asset allocation and trying to time the market, since those are by far the two biggest and really make up that gap between what the overall market performance is and what individual investors are able to do. This screen, I'm going to take a minute to describe it, and it talks about loss aversion. Over the last decade, actually a couple decades, there's been a lot of groundbreaking research in behavioral finance or behavioral economics, and it really has to do with, it's a mixture of psychology and finance. Why do people make the investment decisions they make, and how does that impact them over time? And one of the big issues that has resulted in this is loss aversion. If you take a look at this graph, on the x-axis from the left to the right, the results range from large losses to large gains. And on the y-axis from the top to the bottom, results range from the pleasure or the pain associated with those gains and losses. And as you can see, no big surprise, losses result in pain and gains result in pleasure. But if you notice that black line that moves out to the right really flattens out pretty quickly. And what researchers have found is that the loss associated, or the pain associated with losses, is twice as strong as the enjoyment or the pleasure that comes from gains. So as investors, we dislike losses twice as much as we enjoy the gains. So what exactly does that mean? And we're going to show you a couple more screens that sort of bear this out. And if you take a look here, data frequency, the frequency with which we view returns on investments has an impact on how we invest. Over a full year in 2010, the market returned 15.06%, as shown by the S&P 500 index. I think we're all familiar with that. If you look at it on a month-to-month basis, though, it was we had May and June where the market was very, very difficult, down 8% in May, 5.23 in June, and in August, negative 5.1. What we find is people viewing this information and the frequency with which they view it has an impact on how they invest. No big surprise there. And the next screen here is going to show what kind of an impact that has on our investment decision making. For this, they did a study with investors receiving annual returns versus monthly returns. In the annual returns, the frequency that you would see a negative return if you're only looking at annual returns is 14%. If you're looking at monthly returns, and the previous screen showed that, you see much more frequency of negative returns. So 39% of monthly returns show up negative. Investors were asked to allocate their portfolios, and the ones that viewed monthly returns only allocated 41% to equities, versus those investors who viewed returns that were only in an annual sequence allocated 70% to equities. So I really wish the study would have shown people who saw daily returns and what they would have done with equities, because obviously we're bombarded now in the information age with daily information. You know, the sum total of this is that human beings are not really wired to be investment creatures. To overcome this innate inability for us to assimilate the information in a better way, number one, know the enemy. We fear the pain of loss more than we feel attracted to possible gain. This causes us to overreact and make impulsive decisions. And I can't stress this enough, and it's something that Fortunately, we don't have this discussion too often, but occasionally we have to remind clients and or prospects that no investment decision made while you're in an emotional state is likely to be a good one. What are the solutions to this? As you can see, one, understand that this is a natural emotion. Once you understand that you're likely to make poor decisions under emotional stress or just seeing something negative one day on the financial news, you're likely to take a step back and maybe think, well, let's see what the news brings tomorrow as opposed to making a snap decision. As part of what we're here for today, we think it's a great idea to hire a professional to help take the emotion out of the equation, or even better, a team of people whose sole function is to manage investments. And to that end, it's important to define your goals and objectives up front and have a long-term strategy. The best thing you can do from an investment standpoint is to have a strategy and to stick with it. You can always alter it as need be, but you shouldn't lose sight of the reason your strategy was put in place to begin with. And certainly in monthly, quarterly, sometimes even annually, it's too short a time frame to be altering too much from those precepts. So again, that's one of the problems, loss aversion. There's a few others out there. We're not going to spend a ton of time going through each of the different behavioral issues that plague investors, but we thought loss aversion was an important one, and it sort of summarizes what we want to talk about, which is how to avoid these mistakes. Our strategy, and what we feel is very time-tested, it's been studied, and if implemented correctly, really gets past a lot of the issues that we just talked about. Step one, we diversify across asset classes, and we're going to talk about each of these steps in a little more detail. But step two, select asset class weights. We see a lot of issues with that, even in our view, among some of the professional investing community. Sometimes people will select asset class weights that may have been appropriate 5-10 years ago, but may not today, and we'll talk about that a little bit. Step three is selecting the individual securities. Obviously, we think asset allocation and getting the weights right are the two most important factors, but then you got to drill down and get the right security underneath that. Step four, rebalance. It's a critical step. In our view, some people rebalance too frequently. We think an annual rebalance makes perfect sense, or potentially intermittently, depending on other transactions or additions to a portfolio, things like that, or maybe we've had to liquidate some positions that were legacy positions in a portfolio for a long time. So, we will rebalance more frequently, but studies have shown continual rebalancing on a more frequent basis really doesn't allow certain themes to play out that allow certain asset classes to outperform over the medium term. And step five, and Kim will be talking about this in a little while, we seek to maximize after-tax returns. Everything we do is geared to earn as high a return as possible at the lowest possible risk. One of the things that's often overlooked is, the tax consequences, and that's something that even professional advisors out there sometimes fail to take that into account. They focus solely on the investments and really don't look at the client in a holistic fashion. So we'll talk more about that as well. Step one, diversifying across asset classes. This is nothing new. Most people are fairly familiar with it, but I think this page shows a little bit of why we do that. In the display, we show how different asset classes have historically correlated to the Russell 3000 index. And the lower the correlation, the closer to zero at the bottom of the graph here. The most likely it is, the lower you are to the bottom of this, that the asset class will zig while the rest of the market zags. So we want lower correlation with the market in some of our asset classes. Here we show bonds and how they're much lower correlated with the market than different types of equities. We often see a lot of investors who have diversified among 5 or 6 equity classes and don't have any bonds. Well, guess what? That's not a lot of diversification. You have to get bonds. And something we don't have on the screen here is alternative investments. We have a whole class of investments that have a correlation of less than 0.5 to equities that we utilize quite a bit in our allocations. This shows the benefit of low correlations. In periods going back to 1970 or 1968, actually, where the market has dropped 10% or more, you can see what bonds have done over those time frames. In some cases, they've been up substantially. Well, having additional asset classes like commodities, hedge funds of funds, managed futures, some other alternatives, even provide further diversification benefits with low correlation. The next step, select the asset class weights. How much should we have in equities? How much in large or small cap equities? This slide speaks to that. Number one, from our standpoint, we run a quantitative review of the asset class correlations. It's critical to do this because correlations between asset classes change over time. So it's something that needs to be updated frequently, and sometimes we see correlations between asset classes really increase. Publicly traded REITs that are out there now really have an extremely high correlation to U.S. equities. It's 70–80% in some cases. So, 10, 15 years ago, I believe that was around half of that. So these things change over time, so we always start with what's it doing now. We evaluate the historical risk versus return trade-offs from each of the asset classes. Then we select the efficient portfolio weights. And the efficient portfolio is a little theoretical, but it's basically what combination of these asset classes provides the return we're looking for at the lowest possible risk level. We layer on another phase of our analysis, which is to evaluate global macro trends. And all that means is we're looking forward versus simply looking backward. And I like to talk about, baseball in this regard. If we're picking our fantasy baseball team for the spring, we are going to look at last year's statistics to decide who had the best season, who's played the best. But at the same token, we want to evaluate, Albert Pujols. Do we want to allocate to him? Yeah, I think we do. He's probably going to hit 30 home runs and drive in 100 runs. But he's moved teams recently. So he's going to be playing in a new park. He's going to be facing different pitchers. So maybe we underweight him a little bit in our team. And that's what we do with asset classes. We take a look out there, take a look at the macroeconomic environment, and make some determination on what we're going to overweight and underweight. Then we adjust portfolio weights based on those projections. Step 3 is selecting individual securities. As I mentioned, the first 2 steps we feel are the most critical, but step 3 is also extremely important. Number one, we want to evaluate the security type to fit the asset class. We tend to prefer ETFs where they make sense. They're low cost, they're very transparent, and they're very liquid. But some asset classes we feel benefit from active management, and a mutual fund might fit that just fine. In some portfolios, we select individual securities, individual stocks, and bonds. So we mix and match to come up with the custom portfolio that best fits the client. We're going to evaluate the performance of the manager if it's a mutual fund that's actively managed, and we're going to look at their risk-adjusted returns and the underlying fees of the fund and try to understand, over time, what have they done to adjust their portfolio? Are they a closet index fund, or do they actually add some value? How have they weighted their portfolios given different market cycles? And we'll make determinations based on those data points. We also, once we've selected a fund or an ETF, we have constant contact with the managers, whether they're potential managers that we're thinking of including or existing managers that we've been using for years. We have monthly, quarterly conference calls with them, or they stop in the office, or we'll go visit them. We want to understand their investment philosophy, get a feel for how they're going to operate in different market environments. We want to understand the style that they use with their investing, and also kind of the culture of the company. And we feel that's one of the most valuable aspects of what we do. Most individuals, if they really wanted to spend the time, could potentially get their diversification and allocate assets appropriately, but not many individual investors have the time to really dive into the underlying investments to the level that I think we do. The other thing is, if we're investing in individual stocks and bonds, we believe in fundamental evaluation at that point. We're going to look at their, not just their returns, but their balance sheets, income statements, all the financial statements, and determine if this is the right investment at a fundamental level. Step 4, and we talked about this a little bit earlier, nice graph here, rebalancing periodically. We believe annually is a good time frame. Keeps us from buying high and selling low. Basically, over the course of 12 months, if an asset class has overperformed, it's usually time to probably take a little bit off the table. At the same time, asset classes that have underperformed, this year it's been emerging markets. Emerging markets have had a very difficult year and have underperformed U.S. markets and everything else. Well, it's very difficult if you don't have a disciplined process in place to make the proper adjustment, which is you should add to emerging markets and draw down some of your overweighted positions that have grown a little bit faster. This, done periodically, year after year, helps lower your cost basis and gets you out as things have appreciated, and allows you to invest at times when prices are lower. So those are the 4 steps that I'm going to speak about today. Kim's going to jump back in here and talk about maximizing after-tax returns and some year-end ideas for your portfolios.
Thanks, Terry. So let's move on to step 5. And what is step 5? It's to seek to maximize after-tax returns. And let me stop there real quick and just let you know that we're talking about a taxable account, a non-qualified account, something where you may have an investment, where you may own an investment outside your retirement accounts. Because inside your retirement accounts at this point, there's no tax consequences. So when we're discussing the maximizing after-tax returns, we're talking about taxable accounts. So when it comes to this step, there's some basic tax management techniques. Own municipal bonds, not taxable bonds. The interest income on muni bonds is exempt from federal tax and may be even exempt from state or local tax. If you live in a high, tax state like California and you own some, California general obligation bonds or Los Angeles County water and sewer bonds, then you can collect interest on those, maybe like 4.5% or 5% per year. You're not going to have a whole lot of upside potential, or you're not going to have any, much downside potential either. But it's going to be a nice, constant return. And the great thing about it in this type of an account is it won't be taxable either. So definitely own muni bonds in those accounts. I recommend that for all age clients. You don't have to be in your 40s or 50s or 60s or 70s to own muni bonds. If you start building this portfolio early on in life and allocating a small percentage of your savings to that, over the course of time you build up that portfolio, you retire, you have a muni bond portfolio that's $1 million, $2 million, $5 million, and you're collecting income off of that when you retire and not paying tax on it. So it's really, really a good way to maximize after-tax returns. I like this space a lot, and you could probably tell that I'm kind of a muni bond geek. I managed and Terry laughs at me all the time, but I managed a bond portfolio in my prior life. It was about $1.5 billion, and it was municipal bonds. And so I know really a lot about that market and enjoy that market quite a bit. But let's move on, because I can't talk about munis all night. This is more of a step 5 discussion versus a muni discussion. So what else can we do to maximize after-tax returns? We can definitely keep turnover low in our portfolios. So we don't want to trade a lot if we don't have to. Terry talked about rebalancing on a regular basis, annually at a minimum, maybe once or twice more per year, but not all the time. When you have a lot of turnover and churning in your account, you're going to realize potentially a lot of gains and potentially a lot of short-term gains. And short-term gains are taxed at your ordinary income tax rate, whereas long-term gains currently are taxed at 15%, at least through next year. 2013, as we all know, is a bit uncertain as to where the tax code is going to go. The next step I already talked about, avoiding short-term gains if you can. I will make one additional comment from my CPA days, and I always tell our clients, our investment clients, we never want to let the tax tail wag the dog. Okay, so taxes are very important to consider in any investment decision, but you definitely don't make a decision 100% based on a particular tax situation. You know, if you don't like a name anymore, you sell it, whether you have a gain or a loss. You know, if there's a situation like we have in Europe now, and you know, Terry and I talk to clients, and you know, we've been underweight Europe for a long time, and we continue to say that, then you should have sold Europe, you know, a long time ago and not dealt with that volatility. So never let that tax be the final, you know, decision or 100% of the decision in your investment execution. And lastly, and I'm going to talk about this in a minute or so, but you want to do a little bit of tax loss harvesting is what we call it. And if you have gains in your portfolios this year, and because of maybe some trading you've done, maybe some gains you've realized on some of your positions that went up and you took the opportunity to take that money off the table, there's a way to eliminate the need for paying tax on those gains. And you can look across your portfolio and look for losses in other positions, sell those positions, realize that loss, use that loss to offset the gain. Again, it's a tax play. We highly recommend it, but don't let this, again, make your final investment decision. There's also some really advanced tax management techniques, and that's the last 3 bullets on this page. And with the new regulations that just really went into place for cost basis this year, you know, I think a lot of us are going to start utilizing some of these more advanced techniques a bit more. And so what am I talking about? Kim, what are you talking about, these cost basis regulations? Well, basically, in the past, it was our responsibility, our meaning the individual's responsibility, Kim Renners' responsibility to track the cost basis on the purchases of all her investments. And that wasn't the responsibility of Charles Schwab or A.G. Edwards or Wachovia, you know, wherever she had her assets. That was her responsibility. And so when I sold that particular investment, when I sold my Apple stock at $400 and I bought it at $80, well, I need to report that information, that gain information, to the IRS on my tax returns every year. That was my responsibility. Well, that's changing as of this year. That is going to be the responsibility of the custodian that holds the assets. Now, so it just goes into effect for this year. So if you have owned securities at a custodian for years and years, and you've transferred assets in and transferred assets out, and the cost basis is really up in the air, that's not their concern. But any new purchases of varying securities starting this year, next year, and in 2013, everything will be covered. But they're going to be responsible for reporting the cost basis of your securities to the government at the end of the year. And all that will be on your new 1099 form that will come into your mailbox sometime in January or February of 2012. It'll be very interesting to see how this works out. But the advanced techniques we really talk about tracking holdings by lot or selling individual lots with the least tax, and then really wash sales or one last technique that you can use where you you can sell a security, but if you really like that security, you can buy it back, but you have to actually wait 30 days to buy that back. And again, that is more of a tax rule versus anything. The IRS does not want us to take a loss today to offset the gains that we took earlier this year and then be able to buy that security back tomorrow. They want to have that time period in between, that wait period. So that's really, that is step 5 in the grand scheme of things when it comes to, OJM's high-level strategy. On the next slide here, what really are some of the benefits of tax management? What are some of the numbers behind this tax management, these different bullet points that I just talked about on this prior page? And the two really most simple and direct ways of maximizing after-tax returns is what you can see here. Avoid selling holdings whose gains are short-term, and that makes up about 55 basis points or 0.55% of a potential added return. And then lastly, delaying taking profits that are long-term gains. So basically, if you have long-term gains, really withhold from selling those positions, for as long as possible. And that's another 22 basis points or 0.22% to make up, we're looking, this period that this chart covers is 1970 to 2010, and that, this calculation of 77 basis points, or around 3/4 of a percentage point, you can actually add to your annualized rate of return by just managing taxes within your account. So that's, again, another point that Terry and I really like to make with clients, because, we see a lot of clients come to us and they have a portfolio, and it might be all just mutual funds. And again, we're fine with mutual funds. They definitely have a place in a portfolio. What you have to understand about mutual fund managers is they are managing to their strategy. They're not concerned with Dr. Smith's tax situation. They're not concerned with Kim Renners' tax situation. If they're going to do a lot of churning or have a lot of turnover in the portfolio in a mutual fund, they may generate capital gains that they'll distribute to all shareholders at the end of the year. Okay, and really, I'll give one great example. 2008, the S&P was down 37%. Many mutual fund holdings down 37, down 35, down 45, whatever the number was, because they actually had done some trading in the accounts and they held positions for maybe a long time that were at gains. They sold those positions, and then they ended up paying out capital gains at the end of the year. So not only was your mutual fund position down 37%, give or take, in 2008, you also had to pay tax, another 15% tax on money that mutual fund distributed out to you, almost adding insult to injury. So, as we say, this is one step in a bigger process. You want to make sure that you're managing taxes. Have a discussion with your financial advisor over the next couple weeks to talk about what you might be able to do in your brokerage account before the end of the year to pay less tax. Okay, so to summarize, really, what's the potential benefit for investors in everything that we just talked about? So, what can our wealth strategies add value for clients? Diversifying across the different asset classes, styles, geographies. It's really going to eliminate the need to try to predict market trends because you have exposure to all the different markets in any given year. Rebalancing is going to help us prevent being married to one particular stock and holding that through thick or thin. Because we're going to rebalance, we're going to sell some of our winners, we're going to actually add to some of our losers. And then again, if you remember Terry's step 4, the whole goal of buying low and selling high is accomplished through a systematic rebalancing process as well. And the end is, as I talked about with taxes, it's not what you earn, but it's what you keep. Could you potentially save another 75 basis points or 3/4 of per year, add that to your performance each year, that's going to add up over a very, very short period of time. So that last step in the process is very, very important. Okay, well lastly, let's try to get everybody out of here tonight. I just have one more slide to talk about year-end investment strategies. What can you do really over the course of the next couple weeks before we hit January 1, 2012 to maybe help out in your investment portfolio. So I put together just a quick list here of year-end investment do's and don'ts. And I'll start with the don'ts. So if you're over 59.5 in age, you can take out your distributions from your 401k or your IRA. If you're under that age, we highly recommend that you don't raid that account. Make that a last resort. We understand that is a very difficult economy out there, and we're going through difficult times. But please, we highly recommend you make this a last resort. There's too many penalties and taxes you get hit with when you do something like this. We don't want you to liquidate all of your taxable investments either. It is very volatile out there. Terry and I talk about this every single day amongst ourselves, amongst our team, amongst our clients. And, we're here to provide some balance. And we don't want you to panic. We don't want you to go to cash. If you miss, we didn't include this chart, but there's a great chart out there, a great study, that if you missed the top 5 days and missed the worst 5 days in the market over the course of a year, how much you would underperform just the general index. I mean, the numbers, they're pretty staggering. They're pretty staggering. So, if you want to talk to us about that sometime after this call, definitely go ahead and, shoot us an email or give us a call at some point. Investment dues. So what can we do before the end of the year? Well, we've already talked about it. We've said, let's rebalance your investments. Sit down with your advisor. Go ahead and talk about where you are, what's overweight now, what's underweight based on your long-term plan, and, do some trades. Definitely do some trades to get that asset allocation back in line. Think long-term if you're younger. If you're shorter and you're going to need cash in the short term, short term being within 5 years, you need to be really conservative. So you need to take some of that money and go to cash, go to money market funds, go to short-term bonds, okay? So consider your time horizon and risk tolerance. And just reevaluate all your investments. Every day when you wake up, I always say this, if you will not own every single stock, or if you wouldn't buy every single stock that day in your portfolio, there's no reason you should continue to hold it. So reevaluate your investments. Do this, again, at least annually, if not semi-annually with your advisor. Harvest losses. So this is one thing that I think you can really do that would be helpful in the next 2 weeks. So you want to understand, okay, in my taxable account, how much in realized gains have I taken? Okay, I've taken $40,000 this year. So if I do nothing over the course of the next couple weeks, and I've taken $40,000 in gains, and I'm in a tax bracket that's over the 15% tax bracket, you're going to pay 15% tax on those gains, which is $6,000. So you're going to pay that to the IRS in April when you file your taxes. You can reduce that tax burden. If you look across your account, look at some individual positions where you may have losses. Again, you may like those positions. You may want to buy them back after the 30-day wash period's over. But seriously consider looking at some of those lost positions and making some transactions to reduce your tax bill. There is one thing that's not on this list that everyone also should be aware of that happens in the next couple weeks. It's already started happening. I've briefly touched on it already. And it has to do with mutual funds, mutual fund holdings. So at the end of each year, the different mutual fund managers out there determine what trading they've been doing in their particular fund. And they go ahead and they, if they have gains, they need to distribute those gains to shareholders. So you need, if you have mutual fund holdings in your accounts, talk to your advisor again. Have them analyze what gains you're going to expect. Sometimes these mutual fund companies don't pay their gains out until the 29th of December. They should be announced already, but they probably don't pay them out until the end of the year. But you need to know what those are. Sometimes some numbers are very large. So if you have large positions in some mutual fund companies, you can get hit with these gain distributions at the end of the year and have a tax bill. You just need to be aware of it. Okay, there's definitely something you can do. Again, you can do some loss harvesting. And lastly, the last point on here, Terry, I think you're trying to move me along here, Terry. You can do charitable contributions of stock. It's always a great way to make that contribution to your church, your synagogue, your charity of choice. And instead of giving them cash, what you can do is if you have an appreciated stock position in your account, you can actually donate. In a lot of cases, the end donee will accept these, but donate a stock. And so maybe you can donate one of your favorite stocks like Pepsi that's appreciated 50% since you've owned it 20 years ago. You can take that stock, it's worth $50,000 today, and actually donate that to the church. And you will not have to pay any gains tax, even though you have a nice gain position. The church gets the full value of the position. You have no tax that is owed. It's another great way to make that contribution maybe for the whole next year, and then take a highly appreciated asset out of your account without paying gains. Okay, so these are just some of the ideas. We hope this has been helpful to everybody here on the call. Definitely get in touch with Terry or I. At the end of the presentation here, we have some phone numbers and some information. Lastly, I just want to touch on a few things. So how does OJM, how does our firm work with you, with your practice, with your business? We always offer a 1-hour free consult. That's the first step. So we're going to ask you to fill out a 3-page data form and go ahead, give us a little bit of information, high-level information about you, and then we're going to get one of our partners on the phone, or maybe Terry or I on the phone, and talk to you about your entire plan. And then what we can do, if you hear some things that really make sense, you can decide to engage our firm for personal, corporate planning. So we work with a lot of physician practices, we work with a lot of small businesses, and then we work with those individuals as well. And we can run you through a whole plan that would include, asset protection, a tax review, an investment review, an insurance review. And then, of course, should you decide you need insurance or investment advice, we have the divisions at our firm. We can actually provide you with that service. Lastly, if you do have a practice, a physician's practice, a few of our partners can come and talk to your group. They offer CME credits as well. We have a nice little booklet that they pass out to all the attendees, and typically you just have to pay for our travel expenses to come out and make that talk. So next steps, everyone gets the free book that we talked about. Our partners, our 3 partners have written 11 books between them. Terry and I publish pretty regularly in some of the physician magazines and other small business magazines that are out there. We have an investment article here and there. Also, we have a great website. It's called docworthy.com for any of the physicians here on the line. Again, this is a place to really network, to get really good information about the financial aspects of your life. I know there's a lot of physician sites out there that talk about research or products within your space. I don't think there's a lot of websites that actually have a gathering of CPAs, financial planners, insurance people, attorneys, real estate professionals that talk about financial planning and financial aspects of your life. So go out to the site, free membership, continue your education. That's really what it's all about. That's the first step in making the right decisions, is being educated. And for everyone on the call as well, we'll also, if you'd like, we can follow up. Let us know the best time to call, the best way to get in touch with you, via phone, via email, via smoke signal, as some of our partners like to say. But we can follow up with you and talk in more detail about any questions you may have. So I think we'll have our last poll here.
And Kim?
Yeah.
Prior to the poll, we do have at least one question here I wanted to bring up. The question was, what other assets do you consider part of the portfolio, such as gold, real estate, et cetera? And that's a great question. And apologize if we didn't get to it quite quick enough, but I wanted to before we ended. And we have quite a few. And gold and different commodities are certainly an asset class that we typically have a 5 to 10% allocation to. We'll utilize ETFs and or other investment vehicles depending on the individual client situation. We also utilize some funds of funds, hedge fund options. They're built to earn money in almost any market environment, or at least to offer a lot of downside protection in volatile market environment, and they have very low correlation. We've also started implementing some managed futures strategies. Kim, I don't know, am I forgetting any other ones? Emerging market bonds are something that we've been adding to portfolios over the last several months, if not a little bit longer than that. Anything else you can think of?
No, Terry, you've definitely covered each asset class that we definitely use. And I guess I would just make the final point that, again, when we see a lot of prospects come our way, they have an allocation to the traditional asset classes like stocks and bonds and cash, and they don't have these alternatives. Gold's in the news a lot. You know, we're seeing a little bit more gold in portfolios, which is, you know, a good thing. But there's so many more other asset classes out there that really can be utilized. And, you know, in taking our institutional approach in investment management, you'll see that, you know, a minimum of 20% of your portfolio is going to be allocated to that alternative space.
Okay, and then I think the poll question's up next. So, what is the next best step? And that is we could either schedule a free consultation, contact me to schedule a seminar, or send me a free copy of your book.
Okay, that looks good. Terry, I don't think we usually publish any answers to that question. That's for our file. On this last slide, we have a phone number that everyone here on the line can call at your convenience to talk to either Terry, myself, or, you know, anybody else at the firm. You have our website here and a good email address as well to get some good information. We answered questions, and we will close with a thank you very much. Happy holidays, and we hope that everyone has a very nice evening. Good night.